What is going on YouTube? The Creative Investor here. Now in this video, we're going to talk about how to invest in the stock market, what to look for, what to know essentially. How do you invest starting from zero or a small account? How do you invest and grow your net worth, grow your account value? So that's what we're going to be covering in this topic. There is a lot of new investors and people in my sphere of influence that have been asking me like what to invest in. Should I buy Dogecoin, AMC, GameStop? And none of that stuff's true. That is a recipe for disaster, and we are trying to grow long-term net worth. Now, my goal on this channel is to have you guys in a better position a year from now, really 10 years from now. You should be pretty damn wealthy if you follow this channel and listen to advice of some other people. Don't just blindly listen though. Do your own research. This is not financial advice. I am not a financial advisor. Maybe one day, but I am not right now, so I cannot give you guys financial advice. But you can learn a lot by watching other people, not copying them, but watching them and watching the strategy. Because investing is 90% mental, in your head. It's only 10% of what you're actually buying, what you're doing. You need to learn to control your behaviors, but I think that's the topic for a different video. But if you guys like all that kind of investing content, then this is the channel for you. If you do not, this is not the channel for you. I do not recommend you be somewhere that you do not want to be. So if this is your kind of channel, hit the like button and the subscribe for me. Hit me down below in the comments how long you've been investing and trading for. I would love to hear from you guys. I respond to every comment. So without any further ado, we're gonna jump right into it. First things first. So if you guys are seeing GameStop, AMC, Dogecoin, all those companies that are getting a lot of attention on Facebook, YouTube, social media, those are not good long-term investments. They're just not. If other people are talking up to them about you, more than likely they have a conflict of interest, meaning they want the stock to go up to sell it to you. So don't be the guy that's buying these shares at outrageously overvalued prices, because they will come down 80-90%. And especially if you're a new investor, that is really going to kill your confidence, and that is what is going to crush your beginning of your investment career. Is you're not going to want to, because you just lost so much money. But always go with companies you believe will be around in 10 to 20 years. For me personally, I have Snapchat, Abivai, AMD, Disney, Boeing, Rocket Mortgage, Palantir, Neo, BigCommerce, Qualcomm, Endo, Sony, CCIV, FTOC, which is Payoneer, like a fintech, UWMC, EasyGo, IPOE, Agen. I just got that as a free stock for referring somebody. But the point is, you want solid companies. So there is different ways to invest in different strategies that are working towards your own goals. See, you guys need to ask yourself, what is your goal? Are you trying to make as much as possible? And with that comes a little bit more risk than buying something like Coca-Cola, which is a very established company and virtually cannot go bankrupt or get any worse. I mean, it would be very hard for Coca-Cola to fail as a company at this point. But they pay a 3.30% dividend, 3.3% dividend a year. So basically, whatever you invest, if you invested $1 million, you'd get paid $33,000 a year to hold the company. Now, the company could go down a little bit, it could go up a little bit. You're not going to get a big capital or share appreciation value. Now, you can do something like my strategy of what I've been doing is I'm going for growth companies. I'm going for companies that do not pay a dividend, that are reinvesting and even selling shares still to reinvest that money back into the company to one day pay a dividend or buy back shares to make those shares more valuable. Because that is what the stock market is. It is a forward-looking instrument. So there's different ways you can play it. Like I said, you can go for dividend stocks, which are generally going to be a little bit safer. Anything over a 6 to 7% yield, like even AT&T's at about a 7% yield right now. So there's different strategies you guys can use. Yes, 7.19%. So this is about as risky as I would go. 7%, $70,000 off $1 million per year. So that is a great return. The stock could go up, go down, whatever. But I focus on growth, me personally. And with that, it's just different. You're taking a little bit more risk because growth stocks, they don't pay a dividend. So a lot of people that are retired and institutions that rely on dividends, one, they're not going to touch them as much, and they're just riskier. There's a lot of growth, and depending on the company, like let's say CCIV for example, that might be merging with Lucid. This is supposed to be a growth company, so yeah, it's up. I'm up 88%, almost 89%, because it is baking in a lot of future growth. Let's imagine the merger has been announced, but it is baking in a lot of future growth. Now, there's also a mix of both. See, I have about 60%, 60 to 65% of my account in growth stocks, and then I have about 35% of my account in dividend stocks. And see, I have 60% of my account in growth stocks, 35% in dividend stocks, because I do not want to miss out on the compound growth factor from dividends reinvested, because I am young, and a lot of you guys are probably young too. Even if you're not, compounding dividends can still make a huge, huge, huge impact, and that alone can change your life 20 years from now. So another huge thing I need to point out, though, is you cannot go off of a price of a stock. I hate seeing this. You cannot go off a price of a stock to know if it's under or overvalued. The only metric to use to get an idea, now to know if it's under or overvalued, you have to go in and do a bunch of calculations and figure out what their earnings are, what their profits are, what their projected earnings and profits are going to be, like divided by how many shares are outstanding in the company, and that would give you a relative earnings per share or earnings basis. But like BigCommerce is a great example. Undervalued company at its core. But BigCommerce is $83. So a lot of small guys are like, $83. Oh, that's kind of expensive, right? It's really super cheap, because the only metric you guys really should look at starting off, besides the numbers, which that is always a good thing to look at, and you should always look at the numbers, but is the market cap. And BigCommerce has a $5.10 billion market cap. Now, what a market cap is take all the shares outstanding. Take every share of BigCommerce outstanding at $83. It will equal $5.10 billion. So that is the total value of the company, regardless of where the shares are at. See, the shares could be at $50, like Coca-Cola, and have a $200 billion market cap. So it's giving you the size of the company, not just the share price in determining if it's under or overvalued. So say if this company doubled, these shares will go to 160 as long as they didn't issue more shares. So that's where it's really pivotal to understand what market cap is. Market cap is all the shares outstanding added together, basically. So it would be $5 billion, and that is essentially the value of a company. So if you're looking at dividend paying companies, they're usually more established and going to have a higher market cap, like AT&T and Disney, or not Disney, but Disney has a really high market cap too. But AT&T and Coca-Cola, higher paying dividend stocks, they have over a $200 billion market cap. So they are huge companies. They're 25 times what BigCommerce is. So that's where you get into growth of a company like BigCommerce, is they have a lot of room to go. So I think that was a really good building block for you guys to expand your knowledge about investing. Now, I am going to play a quick video from Warren Buffett himself. And if you don't know who Warren Buffett is, he is arguably the best value investor of all time. So I'm going to play that video. He says some really good stuff that you guys should take note of from somebody who is a multi-billionaire worth around $100 billion. So nothing to sneeze at. So I'm going to play that video and be back at the end to go over it.
If you're investing, if I'm going to buy a half interest in a McDonald's stand and you're going to run it, or McDonald's franchise, you're going to run it, I look to the business to determine whether I made a good investment. And I'm concerned about, whether we have new competition, how we do over the years. But it's the business I look at. When you're just looking at the price of something, you're not investing. I mean, if you buy something Bitcoin, for example, or some cryptocurrency, you're not looking to the asset itself to produce anything. If you buy an apartment house, you're looking at how the apartment house does. If you buy a farm, you're looking at the farm does. If you buy a whole business, you're looking at how the business does. If you buy a part of a business, why shouldn't you look at how the business is going to do? But people get charmed by lots of action and the fact that things are liquid and all of that. And it does have repercussions back into the market when you get something like, an ETN arrangement on the, supercharged on the VIX. I mean, where you can lose 90% of your money in one day. I mean, that really doesn't belong with the word investment. I mean, it's a gambling form of activity.
Although you've said yourself, you talked about this in the annual letter over the weekend, and just even at the top of the show, where when you look around for a business that you want to buy, you can't find any at attractive levels. However, when you're looking at equities, you do see that as a good place. That Berkshire has been a net purchaser of equities this year in 2018, and that's because you like the deals that you're getting in the market.
You can buy small pieces of businesses for less than you can buy whole pieces of businesses.
For the premium you'd have to pay if you were buying the whole thing.
Yeah, so you get a bargain as an investor compared to what I can get in terms of buying the whole business. And people, if they just think of stocks as pieces of business, they'd be so much better off than thinking of them as little things that move around in price. And I think with Berkshire, we have an unusual number of people as shareholders who just look at Berkshire as a business. They look at it as a savings account. They put some money in 20 or 30 or 40 years ago. We retain it and reinvest for them, but we're their savings account. And that's the way I look at my own stock. That's the way Charlie looks at his stock.
Part of the reason that you've been so bullish on equities for many years at this point is the interest rate environment.
Yeah.
You've looked at interest rates and said interest rates are gravity on stock prices, and when interest rates are so low, stock prices inevitably are going to climb. There's been this really weird thing that's been happening in the markets where all of a sudden good news that we got from a good jobs report made people start to worry that interest rates were going to climb and that the Fed was going to raise rates more than anticipated. People got really nervous around that, and you can still see it every time we get up on the 10-year back towards 3%. It gives investors, or at least traders, I should say, some concerns about what's happening. How do you kind of gauge all
a
of that?
bond, if you buy a 30-year government bond, it has a whole bunch of coupons attached. In the old days it does, now it's electronic. But it has a whole bunch of coupons. The coupon says 3% or whatever it may say. And you know that's what you're going to get between now and 30 years from now, and then they're going to give you the money back. What is a stock? A stock is the same sort of thing. It has a bunch of coupons. It's just they haven't printed the numbers on them yet. And it's your job as an investor to print those numbers on. If those numbers say 10%, and most American businesses earn over 10% on tangible equity, if they say 10%, that bond is worth a hell of a lot more money than a bond that says 3% on it. But if that government bond goes to 10%, it changes the value of this equity bond that, in effect, you're buying. You are buying, when you buy an interest in General Motors or Berkshire Hathaway or anything, you are buying something that over time is going to return cash to you. Maybe a long time in terms of Berkshire, but it'll be bigger numbers. And those are the coupons, and it's up to you, your job as an investor, to decide what you think those coupons will be, because that's what you're buying, and you're buying the discounted value. And the higher the yardstick goes, and the yardstick is government bonds, the less attractive these other bonds look. And that's just fundamental economics. So in 1982 or 3, when the long government bond got to 15%, a company that was earning 15% on equity was worth no more than book value under those circumstances, because you could buy a 30-year strip of bonds and guarantee yourself for 15% a year. And a business that earned 12% was a subpar business then. But a business that earns 12% when the government bond is 3% is one hell of a business now, and that's why they sell for very fancy prices.
So by now, I hope you resonate with me and Buffett and some of the other investors you guys might have watched is that you are buying businesses. Now, you wouldn't buy a bad business. You wouldn't buy a house that was falling apart. Why would you buy a company that's falling apart? AMC, GameStop, all those, I don't even need to go into it much more, but they were all dying companies. You wouldn't buy a bad business. So with that being said, guys, you guys just need to look at what you're buying, take a deeper look. If you're a serious investor and you're putting serious capital in these companies, like I am with certain companies, I know exactly how much revenue they are making and they are projected to make. I stay on top of earnings calls. I stay on top of all that. But that's because I am playing more speculative. So if something goes wrong, I need to know about it so I can get out of it or buy more of it. Whereas if I bought Coca-Cola or AT&T, I really don't care what happens. Like, AT&T is a little bit more risky, but I wouldn't care because it's just good businesses. And a lot of the businesses I don't have to follow like that. Like Disney. I have 100% confident in Disney. I have 100% confident in Boeing, Rocket Mortgage, UWM, all these companies, but companies like Big Commerce, Neo, even AMD, you kind of got to watch them. And that's where the speculative can go a long way if they do good and you keep piling money into your highest conviction stocks. Now, I hope this gave you guys some kind of clarity on how you guys should start investing. That's all this video is for, is to how to start investing, how to get the mindset to invest. It's not just trading something, buying and selling. You want to hold as long as possible. One, because if you hold longer than a year, you take a long-term capital gains tax instead of a short-term capital gains tax, which a long-term capital gains tax is about 15 to 20% less than a short-term capital gain tax, which is less than 1 year of time. So if you guys found any value in this video, I would appreciate a big fat like and subscribe. If you didn't, hit me down in the comments below with what you did not like and what your differences of opinions are with the concept in this video. So with that being said, guys, I'm gonna get out of here. I hope you guys have a great weekend. I'll see you tomorrow if you do not hear from me today, and peace out.